ACTI, and then I will be your host tonight. So I have with me Mr. Alfred. It will be your tutor for tonight. Mr. Alfred, kindly, you have the floor now. Alfred, are you there?
Good evening, guys.
So Alfred, before you start, I'm sending you. I'm sending you the YouTube distance so that you can send to them.
Oh yeah, that's true. Please do.
So just forward to the group. How many groups are you? Are you in the 5 groups, Sha?
Yes, I am.
Okay, you can just forward. I've sent to your WhatsApp.
Okay. Thank you very much. Please, you guys will spare me a minute.
Wait,
let me just.
Don't send it yet. I don't think I'm sending the right one. Wait. Sorry. That's not the right one. I'm sending the new one. Okay, yeah, you can forward now.
Okay. You guys should spare me a minute. Let me just forward this to.
Can take your time, sir.
Okay. Okay, let me send to right.
You can share.
Kabiru, are you with me?
Yes, I'm with you.
And the second one is what I'm sending. The second one.
Yeah, any of both of them are the same thing. You can send them.
All right. Hey, voila. Kabiru. Kabiru, are you with me?
I'm with you.
I'm getting that same pop-up. I told you I was suspecting this will happen. You are not allowed to share your screen. You can ask the meeting host to turn on screen sharing. So you have to share it with me.
Yeah,
you have to enable me rather to share. I was thinking it's something else. No problem. Just enable me.
No, you will be allowed now.
Meanwhile, okay, it's done.
We are share now.
It's done. Yes, it's loading. So good evening everyone. So if you can see my screen, just let me know.
Yes, I can see it.
You can see my screen, right? Okay, so
yes, we can.
So I shared this note with the class last week.
We can't see the notes yet, though. Are you going there?
You can't see the note yet.
We can't see the notes yet.
That's what is on my screen now. You can't see it yet.
Now. It's showing now. I think maybe the screen is lagging.
You can see it now.
Eh?
It's lagging. Okay. So but it's everybody can see it now, right?
Yes, sir.
No. Okay, it's okay now.
Stop it.
No, no.
Let me just zoom it out a bit.
It's fine now.
Yes, yes,
It's
sir.
okay, sir. We can see it clearly now.
It's
It's okay.
okay. So it's good to meet you guys. I think this will be our official
That's
meeting.
gone
Last
off.
week, for some reason, our Nigerian network did not allow us to meet. So, as a result of the network last week, I shared this notes with you guys. So, in your icon syllables, there is a portion for risk management, and that takes up to 15% of the syllables, right? And for you to be able to do that, you have to understand how trading works, international risks, international trading and all. So if you go to the syllables, you see things like interest rate risk, foreign exchange risk management, and all those things, hedging. But the reason why I've decided to approach this from my own way is because for you to properly understand everything that has to do with hedging, you have to have a good and in-depth understanding of derivatives, derivative markets. You get. That's why I've decided that, okay, we'll introduce the financial markets, and then I'll introduce you to the derivative instruments, mostly options, futures, swaps, and then after that we can now start looking
Hello,
at
Alfred.
I can pass questions. Yes, I can hear you. I can hear you. I
Hello,
hope
who is
everybody
talking?
can hear me. Somebody called me.
We can hear you, sir. You are very audible.
No, somebody
I
called
can
me. I
hear you,
want to know
sir.
why did that person?
Alfred,
Yeah?
please.
Yes, so can the
We can't
person,
see your screen.
somebody
That was
called,
fine. We cannot see your screen.
or can you see it now?
Is your network?
Is
But
there
others can
anyone
see
who
my.
can't see the screen? I think it's peculiar to that person because I can see it from here.
We can see your screen is from their network. They should log out and log in again.
No,
Can you continue, please? There's no time.
Okay, there's no time. So please try to sort it out from your hand. Sorry about that.
Because I can see the
So
screen actually.
I'll introduce, like I was saying, I'll introduce you to the derivative markets. We'll look at some very random examples. I'll bring you up to speed with everything that has to do with derivatives, and then we can start looking at past questions. Usually, this part of the syllabus comes towards the end when you are close to your exams and you see tuition centers rushing it. But the reason why I've decided to take it this way is because I want you to have a good grasp of it so that by the time exam comes, we are not just rushing things. Ordinarily, I can decide to wait when you are done with your cost of capital, merger and acquisition, and all these kind of things. Then we'll bring this up. But I've decided to start now. So it's a
Alfred,
good thing we have.
are you
Yes.
on that note now?
Yes, I'm on my. I've shared my notes. Can't you see my notes?
No, we can't
No, we
see
cannot.
it. It's
No, we
it's
can
just
see it now.
showing now. It's
You can
just
see
showing now.
now.
So now you can continue.
You are seeing my notes now.
Yeah, we are just seeing it now. Continue.
Okay. So,
And this
so
is
I've
bold.
just
Someone is saying
explained
it's
that.
not bold. This is very, very bold, though. Please continue. This is bold.
See, I've zoomed it out up to like 80%,
It's
right?
very,
So
very
that
bold.
everybody
Please
can see.
continue.
So that is going to be my approach for this course. Okay, so we have a very, very long journey to go together. I'm just doing the things I couldn't do last week. So this is a very more like an introductory class. We are still going to learn, but I just also want to mention some things that I like and some things that I might not really accept. One of it is I appreciate it when you come to my DM to drop messages, and mostly it should be messages related to SFM and things we learn in the class. I'm saying this because from my previous experience lecturing online, I have seen students who, because you are lecturing SFM now, you're supposed to know everything. So they just go, they pick up questions from maybe their school, or some of them university students pick up question. Mr. Alfred, our lecturer gave us this. Can you help me solve it? I have my own things I'm doing, okay? But if it's things that we do in the do here, or anything SFM that you are confused about, I'll appreciate that kind of question. I'll do my best to answer you. And that's it. So that's it. So let's dive in. But if there's anybody, if you have a question, let me know. And if there's no question, let's just dive in. So I dropped this note last week, right? And I believe that all of you have gone through it. Even though there was only one person that came to my DM, I was expecting more persons to come in and ask me questions, but only one person came. It's fine, but I'm expecting that everybody has gone through it, and it's very, very simple. I've tried as much as possible to make the explanations very, very, very simple and understandable. You get. So what I want to do now is explain the notes, ask questions, and I expect you to ask me some questions. Let's rub minds. You get. Let's just take it that we are all learning together. So like I said, it's going to be a very interactive class. So what is a derivative instrument? What is a derivative instrument? I believe some of you have gone through it. Anybody, you can help me. You can help me. I want to see how you see it. I want to understand how you understand it, so that we can learn together. Anybody?
Can you see people raising hand?
So KB, you know what I've observed, because you are the one sharing this link with me. If I go to my notes, to take me out of the screen, so I can't see.
Yes,
people
no,
and
so
all.
you can no, so it's fine. You can swift between the screen. It's not a bad thing.
Yeah,
right?
so I'm trying. Yeah, that's
so
what I'm
if you
trying to
ask,
do. So when they are raising their hands, I need to be here.
so it's
who
not
is
an
raising
issue.
their?
You can
No
see now. You
problem.
see
That's what I'm doing.
Oladimeji. Yeah.
Oladimeji, okay, so it's fine. Oladimeji, just give me your explanation. Oladimeji is fine. Go on. You can unmute yourself and explain.
I think I'm not sure whether the person is because
Oladimeji Temitayo. Okay, so can someone else help?
any other person, right?
Okay.
Omotola Alaba.
I would think that Omotola Alaba. Okay, Omotola, go on.
These are underlying assets. They are the underlying assets. Use as
I didn't get you.
They are underlying assets.
Go ahead, I'm hearing you. I can hear you.
Underlying assets used as a, like what you told us last week, used as an insurance or security for, I don't know, the list I can just, they are just on the underlying assets.
Well,
used in form of
fish. So, okay.
Thank
so
you,
now
sir.
I'm going to explain it. I'm not going to read it out for you. So when you have a derivative is a contract, right? And now that contract is acting as an insurance with regards to the movement of price in the underlying asset. Does that make sense? You have a contract. You are now using that contract as an insurance. So that contract is your derivative. It is what is giving you that insurance as to whether the price of the underlying asset. What is this underlying asset? The underlying asset can be a commodity. it can be an index, it can be a stock, it can be a bond, it can be a commodity. The most important thing for, you know, that people would usually go to the financial market to trade, right? They trade on stocks and other. But what differentiates that stock, normal stock trading, from the derivative now is that in the derivative, there is a contractual agreement between parties that if the price of this stock move like this, we have to deal or do our trade based on the agreement in this contract. So people use derivative to insure themselves in the market from either unexpected losses or uncertainties of the future. You get the point. Does that make sense? So if you look here from the notes, it says a derivative is a financial contract whose value is determined by the price of another asset called the underlying asset. So, like I said, it is the contract. Now, the contract of that, the price, the value of that derivative is determined based on the price of the underlying asset. So, how does this derivative get a value? So you can Mr. A and Mr. B. Mr. A is someone that owns the bread. Let's say bread. Okay, in this place I use tomato, right? So let's say Mr. A owns tomato. Mr. A doesn't know whether tomato price will be 5 naira or 2 naira in the future, right? And let's assume that if it's 2 naira, Mr. A will lose. But if it's 5 naira, he will gain. But he doesn't know what it is going to be. So Mr. A will walk up to Mr. B and say, Mr. B, let us come up with an agreement that at so day in the future, whatever the price of tomato is, if it is 10 naira, if it is 5 naira or if it is 2 naira, you will pay me 3 naira. So if Mr. A and Mr. B agrees, that contract that they have signed that, okay, you are going to pay Mr. B, and Mr. B is going to pay Mr. A 3 naira at a particular day, irrespective of what the price of the tomato is as at that day. That contract that they've signed is what we refer to as the derivative instrument. You get. But the underlying asset now we are looking at is tomatoes. Does it make sense? Hello?
Yes, sir, it does make
Yes, sir. Yes, sir. Yes, sir.
Yes, sir.
yes, sir.
All right. So that contract is what you are using to insure yourself. That's why we are saying it is an insurance. You are using it to insure yourself against a potential loss. And because you don't know what that future holds, you can also be losing if the price of this thing go higher. So it depends on who is the buyer of the derivative and who is the seller. We'll get to understand how these things go, how these things work as we go on. So the derivative instruments, we'll be looking at options. We'll be looking at futures and forwards. Futures and forwards, they are similar but not the same entirely. They have some distinct features which we'll consider in the future, right, as we go by. Then we also have swaps. We'll also look at swaps. So these are different ways that derivative contracts can be signed, right? So an overview of the financial market. Financial markets are systems where assets are bought and sold, including both traditional securities like your bonds, your stocks, etc., and derivative instruments. So in your financial market, you have your underlying assets, which are your bonds and your stocks, and then you have the derivative instruments that they also trade in those markets. You get the point. So the financial market is not just for bonds and this. I know for a lot of persons who are getting exposed to this part of financial markets now, I know it's common for you to think when we talk about financial markets, it's common for you to think that, oh, that's where we trade stocks and bonds, equity and debt to generate revenue as generate capital and all those kind of things. There are also financial and derivatives trading in the financial market, okay? That derivative instruments are used to hedge against future uncertainties, and investors can spread their money across different stocks and bonds. So in the financial market, one of the important things that people can do there is diversify. You can diversify in the financial market. You can trade different financial instruments. If you have options for you to choose from, you have different choose from, because then in finance we'll say you don't put all your eggs in one basket. That's the common idea about diversification, right? Not putting all your eggs in one basket. So by diversifying, you are able to spread out your risk. So if A is doing bad, C might be doing well, D might be doing well, Z might be doing well. You are able to spread your risk, right? So that's one of the risk management. Capital raising, we all know this. You go there to get you can sell financial market, right? Then price discovery. These are not that important parts, because from your basic economics, right, we have the idea of equilibrium market. So people come, equilibrium market price is determined by what? The convergence of the demand and the supply, right? So that's how it is. So people discover prices based on buyer and seller movement in the financial market. So you say price discovery is the process of determining the fair market price of the financial asset based on supply and demand. So the supplier and the demand, the person that wants to buy whatever it is that you have in mind, or your product, when you come to the market, that's when you will be able to determine what the price will be. So you cannot just sit at your house and say, okay, this bread I'm producing, I want to make so much profit. Maybe you spend 100 naira to produce the bread, and you now go to the market and say, I want to sell this bread for 2,000 naira. It is when you reach there that you know whether your 2,000 naira is feasible or not, because there is somebody that is pricing that your bread you are pricing for 2,000 is pricing it at 50 naira. You might get angry and chase him away. There's someone else who will come and say, okay, give me for 500. Then you see another person that is selling that bread again. The person will say, I'm selling my own bread for 300. You will now be forced to bring it down. So different factors will just, at the end of the day, make sure that both the seller and the buyer, they have a particular price that they want to sell. So even this same basic explanation that I've used applies to the financial market. So you that is going to sell your stock in the financial market, there is somebody that is also going to price it at what they can afford. So there is this price discovery that will now come at the end of the day that is fair for everybody. You understand? And this price discovery can, like I said, there are different things that can affect it. We have government decisions, weather, social factors, many things can affect it, right? So those are the, what is it called? Those are some of the ways that we can use the financial market to manage our financial situation. So we now look at trading of financial assets. So trading simply refers to the way in which buyers and sellers come together and agree on a price at which they will sell their product and buy their product. That is, in a nutshell, that's what it simply means. It is the situation where money change hand and also the financial, the instrument also change hand. You understand? So, but in the financial market, how does this work? Please, if yes, I expect this class to be fast. 11 o'clock we should be done at most, but if I'm being too fast, please call me back. Okay? If there's anything you need clarification, call me back. Are we together? Okay. I can see thumbs up. So four activities must take place, right? See, one thing I want you to do, you don't just learn because you want to pass ICANN. Try to relate it to your real life situation, because all these things are not too far away from our daily lives. The same way you go to market to buy meat, buy this thing. Now, I'm not saying they are the same thing entirely. What I'm just saying is that at the bottom of it, these same principles apply, right? When you go to the market, you meet the meat seller. When you meet the meat seller, you give him money. When you give him money, he will cut the meat for you into pieces, right? When he cuts the meat for you, he gives it back to you. He ties it up in a nylon and gives it to you. That is a trade. And it is the same way it applies to this thing. Then maybe if you are the type that is very detailed, you will now go home and take note of it. If you are maybe buying to sell as well, you can also take note of it so that you can keep track of your cost. So it's the same thing that applies. So in the financial market, the buyer and the seller must locate one another and agree on a price. Very important, right? This process is what many people know as trading. It is what we all do. We must first of all agree on a price. So stock exchanges, derivative exchanges, and dealers all facilitate trade. Now, in the market, it is normal for you to just interact directly with the person you are buying meat from. What changes here is that in this financial markets, we now have people that act in between you and who you are buying from. You understand? And these people can be in the form of exchanges. They can be in the form of dealers, brokers, and all those kind of things. You get what I'm saying? So it's not just like you just walk in and find somebody that wants to buy what you know. You have to go through these channels. That's the difference in this case now. So once the buyer and the seller agree on the price, the trade must be cleared. So when we say the trade must be cleared, it means that you are paying money. So once you are paying money, the trade is getting cleared, right? Then once you are receiving the asset that you bought, we say that the trade is settled, right? So the trade must be settled. That is, the buyer and the seller must deliver in the period of time. So when you pay cash, you receive it. There's a time frame that this thing has happened. Now, the importance of time cannot be overemphasized, especially when you are looking at the stock market. Derivative market, as we go further, we'll get to understand why time is important. When we are looking at derivative market, you are trading now, but the timing is different from the parallel time that the trade is done. You get. But when you are doing normal stock and all those things, it is happening at time zero, which is the current time. You get. So the timing is important. That's why the settlement, that is the point of delivery of that financial security, has to be done at a particular time. So the timing is another factor that differentiates between the derivative market and the normal market. So there is recording, normal. This one is what we should know. So once the trade has been done, both parties will take record of their trades, or maybe the intermediaries that is involved will take record of their trade. And all these records are the things that forms the statistics. So if you go online now and check your NSC, you check NYSE, what the New York Stock Exchange, right? You check other, even for some of persons, I'm not trying to take it there, but for some persons that trade on your own, maybe you do, somebody is speaking. Somebody is speaking. Kindly mute if you don't want to ask a question. Please mute if you are not asking a question. Okay, is that somebody is still speaking? Said Mohammed, yeah? Please
Continue.
mute.
I've removed the person. Continue.
Okay.
We are not begging people to
So so the financial instruments are traded in two main types of markets. We have the primary market and the secondary market. I believe everybody should know this. Primary market, where initial offerings are done. One of the main thing there is that in the primary market, you are trading between you and the issuer, right? You are buying the stock directly from the issuer. But in the secondary market, you are not buying from the issuer. So let's agree that, let's assume that my good friend Kabiru now decides to sell shares for Apex, and you decide to buy these shares directly from Kabiru. You are trading in the primary market. But if Kabiru now sells these shares to, let's assume Mr. Adamu. Mr. Adamu is holding these shares, and maybe at some point in time, Mr. Adamu says, okay, I cannot hold the shares again. I need my money and all those kind of things, and decide to sell the shares to Madam Ngozi. Then that trade has left the primary market to the secondary market, right? So, is there any question? I know why I'm asking if there is any question, because there's a question I would expect you to ask normally when we get to this point.
Yes,
So, you know, we've mentioned exchanges. Okay, somebody raised their hand. Okay, I'm listening.
Yeah, thank you. Please, quickly, before we go more further, I want to get a clarification. I've just tabbed it on the chat box, but let me call it retrace it. I want to know the role of derivative in financial market intermediation, because we have always been known with normal financial instruments, stocks, bonds, loan, and all stocks, and all these instruments are denominated in units. My question is, what is the relationship that succeeds between financial instruments, all these financial instruments, and these derivatives? And these derivatives, are they also denominated in units? How does it actually relate with each other, so that we can have this crap once and for all? I like the way you are teaching. Thumb up, sir.
Okay, thank you very much. So, like we said, the relationship majorly is that derivatives draw their value from these financial instruments that you have mentioned. So, whatever the financial instruments are measured in, that's what the derivative instrument will be measured in. But the main difference there is that at the point when we are going to a derivative, we are going to say that this instrument is based on the price of that financial instrument at a future date. You get? Sorry, let me switch over to the meeting so I can see your name. Who asked the question, please? Your names. You can speak up.
Olawale.
Olawale. Do you get my explanation?
Yes.
Does that answer your question? Or you still need clarity?
If I get it clearly now, it means that each of the derivatives has its link with any of the instruments they are trading on the floor. And the determinant of the price of that derivative is realizable in the future, not in the present.
See, they would have agreed it now. They would have agreed it now.
Okay.
But the settlement, that was why when I was mentioning settlement, I said take note of time. The settlement is going to happen in the future. So we are agreeing the derivative price now that okay, this asset, the price might go up, it might come down. You understand? There are a lot of things in the financial market. You do your financial analysis, you do financial analysis, technical analysis, and fundamental analysis, right? FA and TA. And you are predicting that the price might be something like this in the future, or it might be lower than this in the future, but you are not certain of what that price will be. So for you not to lose, because you don't know tomorrow, none of us here knows tomorrow. For you not to lose, you are trying to protect your interest. You will now go to somebody and say, I want this derivative instrument that will determine the price. Will determine the price now, but the settlement of this will be in the future. So you pick a particular date, whatever the price of that asset is in that day. Whatever the price of that asset is in that day, that is not what you pay to buy that instrument. What you pay is the derivative price that you've agreed. Does that make sense?
Yeah. So can we now say that it's based on speculations?
No.
Okay.
Not
Go ahead, so that we don't drag the clock.
You are not no problem, but I would like to explain. I want everybody to go. You are not determining the price of that this thing. The speculation that you are mentioning now is based on the price of the underlying asset, not the derivative. The derivative have an agreed price. Okay. As we go further, it will become clear to you. The derivatives have an agreed. It has an agreed price, but the speculated price is the price of the underlying asset. Do you get?
Okay. Better.
All right. So let's go on. So that's how I like my class, please. Don't be shy. So we now have key players in the
before you move further,
market,
my hands
right? Okay, your hand is up. Let's hear you.
Sir, just to get you clearly, are you saying that, like you said, the price will be fixed? So in that case, I would say is by the settlement date. So the buyer may lose or gain, and the seller
exactly
may lose or gain.
May also lose or gain based on the price of the underlying asset as at that day.
Okay, based on the structure that we have, because the price has been given in the future. So when the time of settlement comes now, okay, so it's either it may favor that person or it may lose because it has been fixed.
Yes. So now let me tell you what people will do, or what you would do. If you buy a bread of 10 naira and you want to sell it before December, right? And you bought the bread 10 naira. You are hoping that you want to sell it for 20 naira in December, but you are not sure if the market price of bread will be up to 20 naira, because you know if the market price is not 20 naira, why would people want to buy 20 naira from you when they can buy it for less from other people? You get the point. So now what you will do is, I bought this bread 10 naira, right? So I don't know whether the price of bread will be 20 naira in the future or will be less than 10 naira. You get? So you now look for me. You now come to me. I'm interested in buying bread sometime around November, right? You now come to me and say, okay, Mr. Alfred, I want to buy bread. So I want to sell this bread for you. I heard that you want to buy this bread you are interested in buying bread in November. I want to sell this bread for you as at the end of November. I will sell this bread for you for 15 naira as at the end of November. You get? I'll sell this bread for you for 15 naira as at the end of November. However, when we get to that end of November, the price of bread is now 20 naira. What you have done, first of all, is to hedge your risk. You have made sure that no matter what is happening, you will not lose close to your cost price, which is 10 naira. You get the point. So you have made sure you will not lose close to your cost price. You have secured a profit of like 5 naira. That's what I'm trying to tell you now. But at the end of November, the price is now 20 naira. Do you know that if you are selling at that market price, you would have gained additional 10 naira from the cost price?
Yes.
You get that point first. But because you are not selling at 15 naira, you have lost 5 naira based on what the market price is. Do you get the point?
Yes, sir.
Does it make sense?
Yes, sir.
Yes, sir. Yes, sir.
Good. That is how these things work. You get. But as we go by, we will now see the peculiarities that come with different type of instruments. We will see the peculiarities that come with the different kinds of instruments. So mainly we'll understand the terminology. So I told you earlier that somebody came to my DM. I think it was the only person that came to me, and he was saying, "No, I cannot attempt the number 2 question because I don't understand what is it short selling or long and all those kind of things." So you need to understand all this. It's sweet. You want them because they feel that it's as simple as if you make sure that these things you soak it in. Yeah, don't worry. So let's continue. So where I am, key players in this thing. This is very simple. Dealers. So a dealer is a person who trade. We have institutional dealers. We can also have individual dealers, right? By institutional dealers, I mean like banks. They can be banks. They trade in the financial market, right? They trade for themselves. So dealers basically are people who trade for themselves. So they make a profit or the loss or loss, and that's profit or loss that they make is what we call the spread. The spread is the difference between the bid ask spread and all those kind of things. We'll get to understand them. Then the market makers. The market makers are people who are always available in the market to buy and sell. They are the people that are always available in the market to buy and sell. So if you have a stock or an asset that you want to sell, because these market makers are always, you know that sometimes you might want to sell your phone. Let's take as an example, you need quick cash. I know you guys are rich, you will not sell your phone, but let's take it as an example. You need quick cash and say, what can I just need this money urgently? So you call one of your friends, bro, your friend name is Nnamdi. Nnamdi, how far? You go buy this phone, and Nnamdi is saying, no, I don't have need for it now. I don't have the money. You go to another person, they say no, and then you find yourself moving all around. But these market makers, they are seated. They are always ready to buy your phone from you. They are always ready to buy your assets from you. The only thing that happens is that based on certain factors, they might price you very cheap. So when they buy it from you, they will now go and sell it higher. So that they are always there to make sure that whatever people want to sell, in fact, they are liquidity providers in the market. They make sure that money is always ready for people in the market. Do you understand that? So whoever wants to buy, they make sure they buy from, rather they make sure they sell to them, and whoever wants to sell in the market, they buy from those people. So they are always available in the market. They also make profit, and their profit is based on the price. So the price that you would sell it normally might not be favorable when you are selling.
Like the Abokis selling dollars in the market.
You can use that. You can use that. I don't with those Abokis too much. People in treasury level, those are always looking for ways. The few times I've dealt with them, they're always looking for ways to price you way below the exchange rate at that time. And that's how it is, Yasha. That's how it is. You can see them as market makers, like those Aboki. Yes, they are a very good example. Thank you very much. So any question on that? So market orders. These are two ways of you making an order in a market. Market orders or limit orders. There are other ways, but these two stand out. Why they stand out is because if you go to any exchange, I'm just going to make a very odd example. I'm not advising anybody to go and trade in any way. But if you have a Binance account, I'm sure everybody here knows what Binance is. For those that trade cryptocurrencies, especially, you can just go and look at what these things in the futures part. They have a futures part, right? I have the app on my phone, so I understand a bit of it. If you go to the futures part, you want to buy, you will see market order, you will see limit order. Now, how does it work? There is always a market price for every asset, right? There is always a market price for every asset. So you would always buy the assets at that market price if you are buying immediately. If you execute your trade immediately, you buy at that market price. But if for a trader that wants to make money, it is advisable or it is sensible for you to buy at a price lower than the market price. Because if you look at your assets in the market, you see the prices are always fluctuating per time. So if you do your analysis, you can now say, okay, this particular asset, the price is going to fall to a particular price. Maybe the current market price now is 10, right? If you buy at that 10 naira now, if you buy at that 10 naira, it means that if the price falls to 7 naira, you will be in a loss. Your position would be in a loss of 3 naira. So what most traders do to protect themselves, that doesn't guarantee that you must make a profit. But instead of buying at that market price of 10 naira, they will go and set their trade at, like, say 4 naira or 5 naira. So that even if the price falls to 7, even if the price falls to 7 naira, the trade will not fail, right? The trade will not fail. What will happen is that the trade will be their order will be waiting till the price gets to that 4 naira that they pick. When the price gets to 4 naira that they pick, that's when the trade will fail. And when that happens, we say you are entering the market with a limit order. That's why you say you execute only if a specific price is met. On the one for market orders, you say execute immediately at the best available price, which is the market price. So with the limit order, you are the one setting the price that you want to buy the assets. With the market order, you are the one, you are buying the assets at the available market price. Does that make sense? Does that make sense?
Yes, sir.
Okay.
Yes, sir.
So trading majorly happens in exchanges, right? Trading happens in exchanges. In the olden days, I'm not saying I experienced this, but I read it. In the olden days, they used to say that people will be in the New York Stock Exchange with their coupons and all those kind of things, and they are looking for buyers and sellers. But we have come to an era where technology is leading in every part, right? So you can sit in Nigeria, you are trading in the Nigerian Stock Exchange, or for people that know, that uses all those what is it called, NASDAQ and all those kind of things. You can be able to trade in the US and buy stocks in China and all those kind of places, right? So because you are not buying directly from the buyer, you are trading in an exchange. One sure that every buyer meets a seller. So you are trading on the exchange platform. You are trading on the exchange platform. You understand me? So these exchanges, for instance, we have the new NYSE, not new Youth Corpus, so NYSE. That's not New York Stock Exchange. We have the Nigerian Stock Exchange. So after for this one now, where we have clearing houses majorly applies to derivative markets, right? Clearing houses majorly applies to derivative markets. Now, why are clearing houses? Why do they apply to derivative market? Is mainly because of the credit risk that exists in the derivative market. So what I have explained so far about derivative, it makes sense for us to think that there is a possibility that one of the parties would want to default, right? One of the parties. So let's take the lady that asked the question and I explained about bread. Let's assume that in Naira, and normally if I buy that bread for 15 Naira, I will go and sell it, right? I would want to sell it so that the price, so at the point where the price is rising, the price of bread is rising, I should be gaining, because in the normal term, I have bought it at a cheaper price. But the lady that is selling that bread to me, if the price of bread for making money, if the price of bread is 12 Naira, I am buying it at 15 Naira. She that so there is a possibility that the parties in this trade now, one of the parties in this trade will be losing as the of that. People might want to default. They might not want to meet the terms of their contract. I just want to run away and all those things are not buy. Now I'm explaining these things with 10 Naira, 100 Naira, a lot of money that goes into these trades. We are talking about millions, thousands of dollars. You understand? That goes into trading. So it's more money too. But the big boys trade with a lot of money. So you can imagine what someone's loss might be. So it's very possible that there is a loss. So where does a clearinghouse come in? A clearinghouse comes in to make sure that the obligation of both the buyer and the seller is met. You understand? So you are not just going to do a derivative and say, you and Mr. B have agreed. No, you are going through a clearinghouse. So at the point where the contract is agreed, there is a clearinghouse and there is a clearing member. Like for those of us who have an account, we know what an account officer is. So I'm going to use an account officer like a clearing member. So the clearing member becomes your account officer for those two of you in that trade. You get, so he's like the one that is your trade will pass through his account. He's the one that makes sure that the two of you are able to meet up with your obligations in that trade. And he works in a clearinghouse, right? So the trader who deals directly with a clearinghouse are called clearing members, right? So you deal in it with the clearinghouse, make sure that your obligations are met. So if you buy a share or a stock as an individual, your transaction ultimately is cleared through the account of a clearing member. Derivative exchanges are always associated with clearing organization, because such trade must also be cleared and settled. With stocks and bonds, after the trade has been cleared and settled, the buyer and the seller have no continuing obligation to each other. However, with derivative trades, one party may have to pay another in the future. To facilitate these payments and to help manage the credit risk, I told you about credit risk already, the derivative clearing house typically interposes itself. And when this clearing house comes in as an intermediary between the buyer and the seller, we have this substitution of counterparties. So the clearinghouse is now representing to the buyer, the clearinghouse is representing the seller, and to the seller, the clearinghouse is representing the buyer. So when this clearinghouse represents both parties, it's what we call novation. You understand? It is called novation. Now we have over-the-counter trades. That's a trade that does not go through an exchange. So maybe they just do, in this case now, is not going through an exchange. Remember, with the clearinghouse, is going through an exchange, right? But when it is not going through an exchange, it's just, yes, they still have over-the-counter trades, right? Like it's not done on an exchange that is regulated and all those kind of things. It's just done out of it. You understand? It's called over-the-counter, and there was a lot of transactions go through the OTC market as well. So that takes us, this is already 10 o'clock, 1 hour. Wow. I hope I'm able to, I was targeting forwards. I was targeting that I will be able to introduce you to forward contracts today, but let's see, the most important thing is the knowledge. We don't have to rush too much. We still have a bit of time. So but I'll share my notes, right? What I have on forward contract, if not this night, tomorrow next, I will make up the notes, complete it, and share with you guys. Somebody wants to say something? Is someone saying something? Okay. So trading volume. Volume is determined by the number of that is taking place in the market daily or annually, just periodically. So if you want to treat as that, you use when you are analyzing which assets to buy, you need to check the volume. Why is it important to check the volume? If you are trading, you check the volume to see the number of trades. The volume also gives you an idea of the number of trades that is going on in that asset. And an asset with a high volume tells you that there is a lot of trade in these assets. You get, people are actually buying and selling these assets. So the number of trades will determine the volume. So if you go to the market and you want to see which asset is doing well, you can also use the volume of that asset to know whether it is doing well or not. So we'll talk about the market value. Now, the market cap is market capitalization is more like the market value of the total stock that is available to trade. You understand? It is the market value of the total stock that is available to trade. That is the market cap, and it gives you, it is gotten by multiplying the price of the assets by the total number of outstanding shares. So the total number of circulating supply, let me put it that way, the circulating supply of that asset is what determines the market cap, right? So you multiply the outstanding shares, what is available for people to buy, by the price of that assets as at that particular time. So it means if the market outstanding shares available to the market if it's 2,000 and the market price of that this thing of the asset 4,000, right? So it means that the total outstanding so changing. So if it goes high, the market cap go high. If the price comes down, the market cap come down, and all those kind of things. So this is another. So normally we can tell that for stocks that have high market cap, they have high market price. And by high market price, it means that if you buy the stock when the price is low, as the market cap increases, your prices, the value of your stock also does what? Increases. As the market cap reduces, the final question, please. Are we together? Paul Madebo. Okay. You have a question?
Yes,
Paul,
sir.
you have a question. I can see.
Yes,
Okay,
sir.
go
Good
on.
evening, sir.
Good evening.
Okay, so my question is respect of this explanation you just gave about market capitalization. Because usually I see on TV when they talk about total market capitalization. Is this what you're referring to? When they say total market cap, that is the share price of the share price of a particular stock?
Shares.
Yes, sir.
Yes, that's it. Yes.
Okay, thank you, sir.
So it's used to value the shares of that company. So you don't want to be looking at it per share. You can still look at it, but if you want to know how well or how big that company is doing, you can use their market cap. You get. All right.
Yes, sir. Thank you, sir.
So notional value measures the scale of a position. Somebody saying something?
Sir, good evening, sir.
Hello.
Hello, sir. Good
evening.
Sir, on this
Yes, I'm with you.
outstanding shares, what does it really mean? Does it mean outstanding shares that are not traded? Hello, sir.
So that's why when I said I believe we are all accountants, right? You know, we have the book value of your shares, and then we also have what is available for trade. That is assuming the company is listed now. Right? So now we are looking, when you are saying outstanding shares, you are looking at the number of shares that is available in the market for trade. Do you get?
Yes, sir.
So
answer your question.
So, Mr. Alfred, so what actually constitutes that total outstanding shares? What constitutes total outstanding shares in the market?
Is the total number of shares that the company have outside for sale. So or a company might have 1,000 shares and they decide to sell 500. That 500 is the outstanding, what they are selling. You get it. And that's what we now use to complete the market cap.
Okay.
What is available for trade? Do you get? Do you get?
Yeah, I can get now. That is like we are
Is
saying
there
that what
anybody
is
that needs
for the market.
So, yes, what they have issued, what they have given to the people that okay, we want to sell 50,000 shares.
Okay.
We want to sell 10,000 shares. That's what is available to the people to buy, to investors to buy. You get?
Yes, yes.
Okay. So notional value position, usually with reference to a particular asset. So when we say it measures the scale of a position, the position in this case is looking at a trade. So it's like, okay, we have the price of this asset is 500 or is 100 here, and then you buy like maybe 50 of that shares. That's the notional value. So the 50 you bought times the 100 naira that is being that is the market price, is gives you the notional value, right? And the price gives you the idea of, so your put is the notional 5,000 times open interest. Open interest is simply the number of positions that you have open at the position is. So for derivative markets, we are looking at it from the perspective of contracts. You understand? In a derivative market is from the perspective of contract. So the number of contracts that you have, be it a buy or offer, a buy contract or a sell contract, at any point open interest. You understand? Any question on that? Okay, so I take it that we continue. Stock markets. So security exchanges facilitate the exchange of ownership of a financial asset from one party to another. We have already discussed exchanges. So majorly stocks or securities, as we might know, they trade in exchanges, right? The NYSE and all those kind of things. Other exchanges like NASDAQ, they rely on competitive market prices to determine the level of trade, right? That's it. Then the bond market is similar in size to the stock market, but bonds generally trade through rather than on an open exchange. So for bonds, like if you want to trade a bond, you don't just go to an exchange like that, right? You need to have your dealer who will do that. So sorry guys, let me take a minute break, just 1 minute. I need to drink some water, right? I've been talking for like the last 1 hour. I'm coming. Just a minute. Okay, guys, I'm back. So that's that. So derivatives often use these markets as the underlying assets, right? We've already talked about the derivatives and underlying assets. They use these markets, that's the assets that are traded in the stock market and the bond market, as the underlying assets. So where are derivatives traded? We have exchange traded derivatives. These are contracts bought and sold on organized exchanges, right? So the features of these contracts, of these derivatives that are traded in exchange traded. So just like the name implies, when you say they are exchange traded, it means that they are traded in an exchange. That's just what it means, right? And the features of these exchange traded derivatives is, number one, they are standardized contracts. By standardized contracts, it means that everything that a financial contract should have is there. You talk about the size. The size is now looking at the amount of the asset that you want to buy, right? Then you have the expiration date. That's the date that the trade is going to execute, right? Then you have the settlement procedures. We'll talk about settlement, which is the time, the delivery of the assets, the exchange of cash, and all those kind of things. So then you have a standardized contract. We have a regulated environment because it's trading in an exchange, like the Nigerian Stock Exchange is regulated, right? So these assets are traded in a regulated environment, so nobody will scam anybody. There is a transparency. Everybody knows the price, right? You know the trading volume, everything. That's why somebody asked me that you see all these things on TV. So there is transparency. Everybody has seen what is available. So the derivative instrument you are buying, you know the price, you know the volume, you know every other key metrics that will guide your decision is available. Then there is low counterparty risk. Why? Because of the intermediaries, like the clearinghouse that we've mentioned, right? So it means that there is always somebody to make sure that the buyer doesn't run away if the trade doesn't favor him, or the seller doesn't run away if the trade doesn't favor him. Everybody will meet up with their obligations as pertains the contract, right? So that's this thing. That's the exchange traded derivatives. Now we have OTC. We already talked about OTC when it is not traded in a particular market. You are looking at the OTC. When it's not traded on an exchange, you are looking at the OTC, right? So customized terms can be tailored to match the unique needs of the participants. Anything from the contract size to settlement. So in the OTC market, you also have customized. Two of you agree, right? Two of you agree on everything when you are going to do the transaction, all those kind of things. The two of you agree. Flexible terms. Parties can negotiate to bring in other things that you feel you need to impute in this thing. You know, it's standardized. You are now, remember when we talk about innovation, right? The clearing obligations, it is a condos, laws and regulation exchange. You are trading based on trade to be like this. So okay, that day I will not buy the bread. I will mix it with all those kind of small things that you just want to use to make the deal favorable to the both of you or to one person, whatever the case may be. But there is room for that flexibility that is not available in a regulated environment. Then there is higher counterparty risk, which is obvious. There is credit risk. One person can default. You might lose money, or if you are dealing with somebody that does not have integrity, you might run away. He will not pay you. If you are even not prudent enough and you give him the assets, he will go with it. That's how it is. So all those kind of things can happen. Regulation and transparency in that OTC market, right? So these are the two types of markets that we have for the trading of derivatives. Exchange traded derivatives, regulated, low risk, customized agreements, and all those kind of things. OTC, There is no or we can say zero level of regulation, though there are still customized agreements, but there is flexible terms, there is higher counterparty risk and low regulation. So the role of the financial markets, I think we've already touched on this earlier, risk sharing. So we know that the risk is always available, right? We always have to deal with risk. And there is a common saying that if you fail to take risk, then you are, I don't know how that saying goes, but let me try to remember it. If you fail to plan, you have already planned to. So, but basically what I'm trying to say, I've just forgotten it right now. It just means that every day in our lives, we are always taking the risk, right? Whatever you are doing, it now depends on your ability to manage that risk. So the financial market always give us the environment to manage risk, right? So, you know, like when I say that every day that we face risk, I am now referring to the first risk that is here, diversifiable risk. This is the risk that you can manage, you get. So what are the diversifiable risks that I can think of now? In your house, you need to make sure, maybe I'm sure every one of us now, the way society is, everybody is living in a tiled apartment. So living in a tiled apartment, what comes to your mind first? You need to that maybe your kid or even you or somebody might step on it and slip and fall kind of things. So these are risks that you can manage. They are obviously there. We've seen online cases of things like fan or television or something falling, right? But it doesn't mean that you have to take that fan away because you actually need it, but it might fall. So what do you need to do that? So to make sure that your fan doesn't fall, now decide, okay, ceiling fan is not safe. Let me go and buy fans in their house because of they are just need. So they are called unsystematic risk. But what about the risk that you can't manage? What about you just wake up one day, God forbid, and the next thing you see, earthquake is happening? We have never experienced that in Nigeria. I don't know. It's the one we have experienced. Look for a way to manage it, right? You have to look for a way to manage it. So I believe when you are doing your cost of capital, have you guys started cost of capital already? Yes, like give me a thumbs up if you have started cost of capital with my colleague. Yeah, so as time goes by, I'm sure you would learn more about diversifiable and on the systematic and unsystematic risk in your cost of capital. I think when you are trying to gear and ungear and regear and all those things, so that you remove the systematic risk and all those kind of things. When you are doing that, you will learn more about that, but I'm just brushing it. So if there's any question you have regarding this, I'm just saying that basically with respect to what we are learning, the financial market enables us to share risk. How do we share it? You share risk by diversifying, right? So when you are diversifying, you buy other assets, and as you buy other assets, you make sure that when one asset is losing, when one asset is gaining, you can other asset is not when one asset is losing, other assets are gaining. This is diversifiable risk. But how does the system and the financial market enable you to manage non-diversifiable risk? Is through risk sharing, right? Through risk sharing. So You are able to share your financial risk. You are able to share your risk with somebody else. Who is this somebody else? Like the financial, like your bank or your insurance company. You are able to share this risk with them. Now, what are the possibilities of earthquake or of you getting an accident? You cannot predict that. So if you have an accident, it's part of systematic risk because you cannot diversify that away. But the way you can be able to share that risk, if you insure your car, you have shared the risk with your insurance company. So the insurance company will be able to pay you, even if not buy the whole, buy a new vehicle for you, but they will be able to fix it or do one or two things that will reduce the burden on you. So the financial market provides that avenue for us to share risk with other persons. You understand? Directly or indirectly. Even your money that you keep in the bank, you are sharing that risk of having that money with your bank. That's what you are doing. I know to you, it's just like you are saving, but you are sharing the risk because the money is in the bank. If anything happens to your money in the bank, sooner or later, right, you will get paid. Sooner or later, you will get paid. But if you keep that money in your house and something happens to it, maybe you get robbed and all, who is paying you back? Absolutely nobody. So you're able to share your risk with that bank. You get, that's another way of sharing risk through the financial market. Does that make sense to anybody? So the use of derivative instruments, risk management, we've already spoken about this already. I'm not going to explain too much on it again. When we start looking at interest rate, exchange rate, currency risk, we look at this hedging exchange rates. We'll look at this, how to use forward and forward swaps and all those kind of things to hedge currency risk. Interest rate risk, we'll also look at it, right? So, but I think I've brushed this a little. Speculation. So, say somebody mentioned something about speculation the other time, and I told you that the speculation actually lies in the prices of the financial assets, that is the underlying asset, right? But with your derivative, you have a fixed price that you have agreed to deal on a particular day. So what does that tell you? It tells you that the derivative instrument is important in managing speculations. You get, it's important in managing speculations. So arbitrage, I'm going to explain arbitrage, though there is a lot more to arbitrage. I don't know if we'll look at it, but as time goes on, but I'm going to explain arbitrage on the face of it. So arbitrage is a situation where you have, okay, let me go to the market. Like normal market, your market that you attend, that you go to buy bread and akara and all those things. That's what I want to use to explain arbitrage, because I don't want to go into the, then when I do that, we'll look at the financial market. So you go to your market to buy akara. You go to your market to buy akara, right? And then you also are an akara seller. Maybe you do wholesale. You do retail, and you go to buy from some wholesalers, and you see that seller one is selling their akara for 10 naira, right? And seller two is selling their akara for 5 naira. This is a very basic example. I'm not saying that is entirely what it is, but I just want to give you the idea. So seller one is selling for 10 naira. Seller two is selling their akara for 5 naira. So you are saying that there is an opportunity for you there. Why is there an opportunity? Because it means you can buy this akara in one market and go and sell it immediately in another market and make quick money. A lot of people do this thing to make money. These arbitrary situations happen, though they are scarce, but there are people who take their time to analyze markets and see where every small opportunity is for an arbitrage. So what you will do is that you will now go to seller 2 that is selling the akara for 5 naira. You buy that akara sharp. You take it to seller 10 market, a seller 1 market, and sell it for 10 naira. You have made a difference or a spread of 100 million. That's the volume of your trade. You see that you've made a lot of money. So this is simply what arbitrage is. It is a situation where the price of an asset is different in one market, let me say exchange now, from what it is in another market. So traders, dealers, or whoever the case might be, that finds this opportunity early will buy it from the cheaper market and sell to the now because of the problems in the financial market, because people lose money. As you are making money, people are losing money, right? So the forces of demand and supply. Let's imagine that, okay, sorry, I'm just going to pick your names. Let me see if I have, okay, I have Grace Udo, I have Paul, I have Musa. Let's imagine that the 3 of you spot this arbitrage situation. Grace spot it first, she buys. She tells Paul, Paul spot it, he buys. She tells Musa, he tells Musa, Musa spot it, he buys, and go there. So all of you are quickly doing these things to make profit. By the time you are doing this thing, there is information that is passing from A to B to C to C to D. And as you are making money, somebody is losing money. That's just how the market is. So because of this spread of information, there will be huge demand in the market that sells cheaper and huge sales in the market that sells higher, right? So markets would want to avoid this situation because they are losing. Even the market that is selling cheaper is losing. So because of that, there is always this possibility that whenever an arbitrary situation comes up, the market closes it immediately. So you immediately see the prices closing in immediately. And this also works through the forces of demand and supply. You get, because as you are buying from this market, you are also selling in the other market. So at some point, there has to be an equilibrium. Go back to your basic economics. So at some point, there has to be an equilibrium in the price of that asset. So the arbitrage situation will close up. That's simply what an arbitrage is. So in this place, we are explaining that arbitrageurs, that is people that trade in arbitrage, profit from price differences in different markets or forms of the same asset. Example, buy an asset in one market where it's underpriced and sell it where it is overpriced. So benefit, arbitrage help to correct mispricing and make markets more efficient. So how does this apply to your derivative instrument? Because of the possibility of speculation, because there is speculation and you are not certain of what the future prices will be, people use derivative instruments to make sure that even when there is an arbitrage, if, for example, the assets that you want to sell, remember, if one market is selling low, another market is selling high, you that is trading, you are trading in market B. How are you sure that the market you are trading is where the arbitrage is, the market that is selling low? And how are you sure that the market you are going to buy is the market that is selling high? So people use derivative to safeguard themselves from these situations where they can lose massively. And they can be hearing that, from so place, if you had sold like this, you would have made money. So they use these derivative instruments to protect themselves. Does this make sense? Like I said, we might go deep into it or not, depending on how things go, right? But I just want to know if this makes sense to us. Okay. Thank you. Buying and short selling of financial assets. Every trade has a cost. The most prominent being the bid-ask spread. Now, the bid price, the price at which you can sell or what a buyer is willing to buy is the bid price. So put yourself in a seller's position. The price that you are selling is the bid price, right? The ask price or the offer price is the price at which you can buy or what somebody wants to sell to you. So what is a bid price to the seller could be the ask price to the buyer. You understand? But now, the spread, which is what we know as the profit, is the difference between the bid price and the ask price. So if you bid, let's assume you are A now. If your ask price is lower, if your ask price, I want to put it in a way that is clear. Okay. So let's assume that you are going to buy. Is somebody going to say something, or we have somebody that wants to interrupt us? I thought I heard a voice on the background. Okay, that said, let's assume that you are going to buy an asset and you buy the asset for a lower price. That means your ask price is low, right? Now, let's assume you are going to sell that asset and you sell it for a higher price. That means your bid price is high. There are a lot of confusions in all these things. That's why I'm taking my time to explain it. It might look very simple, but when you are telling your bid-ask spread and they give you an example, the thing will start playing Jangolova inside your head. And you'll be thinking, who am I? Am I the one selling or am I the one buying? I know where I'm coming from. So the confusion is there, but that's why I'm taking. So put yourself, let me explain something before we go further. Whenever you are approaching a question, try to, first of all, as basic as it might be, draw a small picture of a man and a woman. Let the man be the person that is buying and the woman be the person that is selling. That is one way you get this thing. So you don't confuse yourself. It's very simple, but as we go further, when you say this is the ask price, it will throw you off balance. So now that's what I'm explaining. Ask price is the price at which you can buy. So the price at which you can buy is the same price at which someone else is selling, right? So you need to know who is the seller before you can be able to say whether it's a ask price. You need to know who is the seller or the buyer, because ask price can be for both a buyer or a seller, depending on which perspective you are looking at it. The same thing applies to a bid price. So you need to know who the buyer is first before you can now be able to say whether that price is the ask or the bid to that person. Then you need to know who the seller is before you can be able to know whether the price is an ask or a bid to that person as well. So, but simply put, the difference between the price at which you buy and the price at which you sell is called the spread. And that spread is what we call the profit for your trade. You get. So if you buy a stock, is somebody asking a question? Go ahead.
Yeah,
the floor is open.
Yeah,
we don't have much time.
Mr. Alfred, sorry. So for us to really get this ask and the bid price, it means that at a very particular point in time, we need to take a position. Am I talking from the buyer's perspective, or am I talking from the seller's perspective? So not considering the other person that I'm dealing with. I think that's the best way we can look at it. Am I taking the best position? Take a position.
Yes. So you need to understand where the question is coming. Is the question coming from the buyer's perspective or the seller's perspective? So that's why I said no matter how basic it might look, draw a picture of a man and a woman, because I know how I can say their question. They will give you 2 pages. So by the time you finish reading itself, your head has scattered. So you can draw a small picture and say, okay, this is the buyer. Name the person, Ngozi, or what can you say? This is the, I'm just saying that's my own way of seeing it, because I like simplifying things as much as possible for clarity. As much as this might sound funny, it might throw you off balance in the exam. You understand? It might throw you off balance in the exam, and you just find yourself running in circles. But that's I think we've said enough about that. There's no much time. So we know what this bid and the ask price is. You just need to take a position like you have said. Then the spread is the market maker's profit, right? Which is the difference between the ask price and the bid price. So okay. We have a small explanation here. To buy stock, you contact a broker, right? There is a commission. So when you want to buy a stock, you contact a broker, there is a commission, right? The commission is the money that you pay to the broker, right? So you are now buying the stock. So someone else is selling to you. You understand? So your price is going to be what? The ask. You get. So you pay a commission, which is a transaction fee you pay your broker. Suppose that you wish to buy immediately at the best available price. So in this example, we are saying you are buying at the market price. Remember when I told you about the market order and the limit order? So you are buying at the best available price, right? It's the price that is available, not the price that you set. Purchase will probably be completed in a matter of seconds. Where does that stock that you have just bought come from? It is possible that at the exact same moment, another customer called the broker. Another customer called the broker. That customer that called the broker will also pay the broker a commission to sell. You pay the broker a commission to buy. The other person is going to pay the broker commission to sell. The broker to put in an order to sell. So you have the ask. That person has the what? He has the what? The bid. More likely, however, a market maker, we talked about a market maker, sold you the stock because the market maker have that stock available. As their name implies, market makers make markets. If you want to buy, they sell, and if you want to sell, they buy. In order to earn a living, market makers sell for a higher price and buy for a lower price. If you deal with the market maker, therefore, you buy for a higher price and sell for a lower price. This difference between the price at which you can buy and sell is called the bid-ask spread. We already talked about the spread, right? So let's look at this very simple example. Suppose XYZ is bid, right? Suppose XYZ, let me put this here and see. Sorry, I'm going to zoom it out a bit. I hope you can still see. Please, if you can still see my screen, let me know. If you can't, okay. So we still have 91 persons in this class. That's good. All of you will pass. No wahala.
Amen.
You know why I'm looking at? Because I'm just looking at. Oh, now it's
Amen.
It's 10:46. Some of you might want to go to church. For the Christians amongst us, for you to still be here, that means you are very serious. And we'll be having a lot of no, I won't say late night classes, but we'll be having classes close to this time, because most from you to be here. So if you are here, I will take you very serious, because I feel that you are willing to sacrifice your sleep and rest to pass. So you are going to pass. It's a done deal. Agreed. So suppose XYZ is bid at 49. So this is your bid price, right? And offered, which is your ask, at 50, right? So we can already see that you have a difference of around 0.25, right? Between the bid ask. And the commission is 15 naira. So if you are looking at your trade, do you think your profit will just be the difference, the spread? I want somebody to answer me. Do you think your profit will just be the spread? That is the difference between the price, the bid price and the ask price. Is somebody there? Just anybody?
No, sir.
No, sir. Good. Because you are paid a commission. So that
Commission is going to
commission
be
also forms part of your cost, right? So, and the commission is 15 naira. If you buy 100 shares of stock, you pay 50 times 100, right? 100 plus the 15 naira, which is equals to 5,015 naira. If you sell immediately, you are still going to pay a commission again, right? So you receive, in this case, you now need to take out that money that you are that you paid initially. So if you immediately sell them, that you immediately sell the shares, you receive the 49, which is what? The 49, which is what? The bid price.
The bid price.
Times 100 shares minus 15. So the difference between 50,000 and 5,115 minus 49,600, which is 55 naira in this example, gives you your actual profit. Does anybody have any question about this?
Yes, sir. Please, more clarification. It's not that clear
It's
to
a
me,
very
sir.
clear and basic example. Okay, explain. Just tell me what your confusion is. Hello? Hello? Somebody said it's not clear to him, and I'm asking, just tell me what, is it that you don't understand anything at all? Or there's a particular place that you are confused about?
Well,
Hello?
good evening.
How
Sorry,
to determine
my
the
own confusion
profit?
is that is the bid amount not supposed to be the amount we buy, and then the offered amount, the amount is sold? Because we're saying that we buy at 50 naira and sell at 49 naira 75 kobo. Should it not be to buy at 49 naira 75 kobo and sell at 50 naira?
If I may answer, sir.
Okay.
Okay,
go on.
Our lecturer had already explained this. It depends on the perspective of the buyer and the seller, who is buying and who is selling. That's how I see it.
Good. That explains it. Like I told you, always take a position. Somebody say take a position. Me, I say draw small girl and not small boy. So suppose XYZ is bid at 49. So now we are looking at this. XYZ is not a person, is the asset. You understand? So XYZ is bid at 49. So you take a position for yourself. So the bid price, I'm going back to the top of this note. That's why I zoomed it out a bit so everything can show. So I know that when I was telling you guys about this, it looked very simple, but I know this confusion will come up. The bid price, the price at which you can sell or what someone else can buy, right? So it depends on where you are looking at it from. So if you are looking at it from your own perspective, you might be right about what you just said. The other person, sorry, I don't pick your name, so because I'm not looking at the screen, you get the person that asked the question. So you need to pick a position where you are looking at this from. So this bid price, you can say, okay, to me, I'm the one that is selling. So I am selling for 49.75. You get, someone else is buying, and the person is buying for 50 naira. You get. So now this question is looking at the position of, from the way I understand this question, it is looking at the position of the assets from the perspective of the broker. You get? So if you look at it now, you are buying this asset at, someone has come to you that, okay, sell this asset for me, 49.75. That's the buyer. Sorry, that's the seller. And someone else is buying at 50. So the difference between that, multiply it by 100 plus how much the commission that the broker received initially for, first of all, for the bid, right? At the point where you are now going to sell it. Okay, sorry, I think there was a bit of mix-up. Let's not look at it from the position of the broker. I was thinking that would have been easier for us to this thing. It would have been easier if it were in a board. Let me do an Excel. If this will help. Can you see my Excel?
Yes, sir.
Okay. So let's go to the question.
Sorry, sir. Please, how about you share your screen, like the Excel one side and the equation the other side?
I didn't get you.
I was suggesting that for clarity, if you can share your screen, like the document, maybe at the left, then the Excel at the
If
right.
I can do that, but my concern is it might be too small for you guys to see. You get?
Let's just pick out the variables
You can actually zoom in.
in solving. Let's just pick out the variables.
You can actually zoom in.
Are we together? Can you see this?
It's better.
Yes.
Can you guys see it?
Yes, we can.
Yes, sir, we can see it.
Yes, sir.
Okay. So the question say you bid. Now I want all of us to walk through this together also. Your contribution is needed. The reason I'm doing this is so that all of us can be in a position together. We just have 5 minutes left. I think the meeting will go off by itself. So let's try to be fast. So the bid. So let's assume it is you now. You, Mr. A. You is Mr. A. So the question say, suppose XYZ, which is the asset, is bid at 49. So Mr. A position, price at which Mr. A can sell, right? What a buyer. So Mr. A in this case is the seller. So he's selling at what? 49.75. Do you agree with me?
Yes, sir.
Do you agree with me? Okay. Now,
Yes, sir.
you sell. So you sell. I pray that we are able to round up in the next 5 minutes so this thing doesn't close. You sell at 50 naira, right?
Alfred, it won't go up. I gave a distance for 30 minutes, so it's still 11:30.
For 30 minutes.
Yeah.
Okay. Okay, that's good. Thank you. Please just excuse me for a minute. I need some water too. Still. So, okay, let's go back. So you buy A 49.5.75 and you sell 49 points. So we can also look at this from this perspective, this minus this, right? Times 100. Or let's do it the way they did it here. Equals to this times 100. Times this. So if you have this, now don't forget you are the one that you buy, right? You buy at 49 and you are selling at to B at 50. So ordinarily, because you bought cheaper, which is 4,097 this thing, you are selling, this is what you are getting, 5,000. I'm coming, I know there's something you might think I'm missing. So ordinarily, you are gaining 25, right? Which is the same 25 we got here, right? 50 times 100 plus 15. So now, you now remember that there is what is it called?
Commission.
The commission that you pay to the broker. So this is where my own question is now coming, where I'm thinking that, okay, there might be an issue with the question. If you pay your broker a commission to buy, right? That would have been part of your expense. Do you get? So we are going to bring that in here. So you would have taken 15 naira out of your hand. So plus this. Do you agree with me?
Yes, sir.
Do you agree with me? Okay,
Yes, sir.
good. So,
yes, sir.
Now, at every point that a broker does a deal for you, there is a commission for it. This is where I have a concern with this. So there is a commission for this, and if somebody, you are using a broker to buy and sell an asset, the positive sign that is coming here is where I have a concern with. You get? Because you would have paid the broker to sell that asset, and you also paid the broker to buy that asset. So at every point, the total amount you would have expensed based on commission should not be 15 minus 15. In other words, that was why, you remember when I was saying, I said they are looking at the question from the perspective of the broker. But it should not be. Because at every point, the broker should have gained 30 naira on this trade, and you would have lost 30 naira on this trade. So your profit on this trade should not be like this. It should still be minus 15. Do you get my answer, my perspective to it?
Sir, I'm thinking
okay,
that this transaction is not conducted by same person. You see, the person that is asking and the person that is bidding might be different persons. So the stockbrokers is in between the two. So it's just like a landed property. When an agent says, I want to help you buy land, you understand now. For the person that he assists to buy, he gets commission from him. For the person that actually sold, he also gets commission from him. So it is only the commission that affects you as a buyer that will only affect you, and the one that affects you as a seller is what that affects you. But the agent in between, which is the broker, is the one that will gain from two of you. But each of you will only have one leg of the expenses, the additional expenses. Not that it is the same person that will suffer the two. That's just the way I'm thinking.
Okay, I get your question. I get your explanation. Now let me ask you the question. Now we are not. This question is not coming from the perspective of the broker. Do we agree on that first?
Yes, yeah, we do.
It's not coming from the perspective of the broker. It is coming from the perspective of both the buyer and the seller. So at every point that the buyer and the seller is dealing with the broker, they pay to that broker. Do you get the point? Do you get my point?
My
You pay
concern
a
is
commission to that broker,
Yes,
which
sir,
removes from your hand. So if you are one person, maybe you buy this asset and you are now selling it, it means that at both times, that $15 would have and 15 naira would have left your hand to the broker. So what you buy the assets minus what you pay to the broker, and what you sell the assets minus what you pay to the broker to sell. Does it make sense?
Yes, sir.
So if you do it that way, it means that from both the selling and the buying position, both your bid and your ask position, you will take out your $15, which will now bring your total profit to 35, not 55 naira.
Yes.
Does it make sense?
Yes.
The reason why you're having that 55 naira is because the 30 naira now that is the broker's money has been added to your profit, which is giving you 30 plus 25 is 55. Do you get the way I'm explaining it now? So there is a misunderstanding in this question, the way the working was from the text that I picked it up. I didn't look at it properly initially. So this is what you should be having, because you are paying to look at it now. They say to buy a stock, you contact a broker and there is a commission. So you always pay a commission. Whether you are buying from him or you are selling from him, you have to pay a commission. Is anybody still confused about anything?
Yes, I have a question, sir.
Go ahead.
So, good evening, sir. My name is Kazim. Sir, in a trade, a trade consists of, let's say, two parties, the buyer and the seller. And then from your explanation, you said both, if you are buying, you pay a commission fee, and if you are selling, you also pay a commission fee. So now, I want to ask, is it that at every point of transaction, both the buyer and the seller pay commission fee concurrently, like both of them, do they actually pay? Or is it the person that is buying that pays the commission?
The both of you pays a commission. But now let me explain why I'm telling you that this question. In this question, they are saying that you as a person, that's why I say you buy. You sell to, this is supposed to be to be. They are looking at it that you buy this asset. Let's assume the asset is bread. You buy bread from a broker for a cheap amount. That is how I see the question. You buy the bread for 49 naira. You now bought this bread. When the bread price now increased to 50 naira, you went back to this same broker and you told him to help you sell this
Sorry,
bread.
AY, can you mute yourself?
You went back to this broker to help you sell this bread. Do you get? So the broker is going to sell that same bread to somebody else. So this transaction involves, how will I put it? It involves let me draw a bigger picture. It involves like 5 or 4 parties. It involves you, number one, right? You are Mr. Let me say Alfred. You are Mr. Alfred. It involves your broker. It involves your broker, and it involves a seller. Seller 1. Let me say seller 1. Then,
Alfred, sorry, can you zoom out the Excel?
If I zoom it out, okay, let me do it like this. It's better.
It makes sense. Yes.
So your broker now is constant in this trade. This is what I am seeing in this example here. It's constant. Your broker is constant in this trade. You are constant. Right? You have a seller 1, and then number 2, the same you again. You go back to your, let me create another column here. So this is your buy. This is when you are buying. You buy first and then you sell. Right? First, now you buy. You buy, you meet a broker. A broker buys from somebody that sells for you. So you have paid commission 1 here. You have paid first commission that left your hand, minus 15. Now you go back to that same broker to sell that same asset back. So you have a broker, that same broker. Remember, the broker is constant. Now you now have a buyer. So the broker now goes to find another buyer. Whatever commission this seller and buyer are paying to this broker is not your business in this question. You understand? Because if you look at it, say if you buy 100 shares of stock, so they are talking to you. And if you immediately sell them again, so they are still talking to you. So you buy from your broker, you sell back to somebody, you through your broker. So you are still paying him for selling, minus 15. Does it make sense now? Is anybody still confused? So that's why I'm saying that at the point where you buy for this cheap price of 49.7, you pay a commission. At the point when you sell, you also pay a commission. That is why they cannot do a plus sign and a plus sign, because you are paying commission to your broker for every trade that it takes for you. Do you get the point? Please, is anybody still confused?
Hello, sir.
I'm with you.
Okay, sir. So my own is the commission we are paying. Will it be calculated based on the volume of shares we are buying or selling?
The question, see, what you're asking now, the question does not give us that scenario. So I'm not going to tell you a yes or no, because I'm trying to clarify this question. You get? But usually they have their brokerage fee. Whatever they decide to use as the benchmark for it, it can be maybe a market fee at the particular time. It can be based on volume. I don't know what the situation is, but in this situation, they are just telling us that it's 15 naira. You get? So what determines the brokerage fee? Sometimes it's a commission. It can be a percentage. They can tell you that it's percentage of the market value, of the market price. Maybe you can pay 5 naira. So I think I copied another question and dropped here that was based on percentage.
Yeah. I think the way Bamboo does or something, I think those ones, they don't charge your volume. I think they just charge direct, like probably they are charging maybe for a stock of 10,000, you are going to pay 200 there. So maybe not. I think that one is not based on volume or something.
It's not based on volume.
If they use volume, they will be charging people a lot of money, because they are institutional traders and all those kind of things. There are people that even trade in billions of naira. So if you use the volume of what they are trading, I think it will be absurd. I think so. But I I would want to believe that if you are trading in a regulated market, there should be some form of regulations that determine this commission. So without wasting much time, I think this should clarify this question. So this should be minus minus. Yes, from the way the question is presented, it should be a minus minus, because this is what we pay to buy the asset and what we pay to sell the asset. Yes, go ahead with your question, please.
All right, sir. Thank you. The only thing that is like I want to clarify, you know, when you were giving the explanation about bid and offer, you said bid is the one you are willing to, as in the price at which you want to sell, and the buyer is willing to buy. Why offer is the one is like the asking price in which you want to buy. But in this context now, in this what do they call it, in this question, is as if it is the reverse that is the case. Because if the bid is what the person is now buying instead of what the person is supposed to sell, which another person is willing to buy. So that's just where my confusion is. I just feel that the English is kind of mixed.
Exactly. You see, when I was teaching this,
Yeah,
it's
exactly,
not
sir. Exactly, man. Sorry.
a lot of persons have this confusion. When I'm learning this, when I was learning all this too, I had my own confusion, right? That was why I was taking my time to tell you guys about bid ask spread. And there are a lot more things when we start looking at options, when you start hearing things like puts, buy the put, sell the call, buy the call, sell the put, you'll be thrown off balance. But calm down. Now let me answer your question. Now, I told you to think of this question as you. That's why I told you, take a position, draw a baby. Anything you need to do that will make you comfortable, draw it. It is you that is buying. And you can see the bid price, the price at which you can sell, or what a buyer is willing to pay, right? So now if you come to this question, they say, suppose XYZ, which is the asset, is bid, right? Is bid. So let's say is bid, the price at which you can sell. Okay, I get your question now. So if you are looking at the bid price, the bid price now, which that means the price which you can sell is 49. We are still correct, right? We are still correct.
You will not be selling for lesser instead of the gain that was explained earlier. Because if you are willing to sell 49,
you are not selling for lesser.
Offer,
Madam, calm down. You are not selling for lesser. You are selling for higher. You understand? You are selling for higher. Suppose XYZ is bid at 49. The bid price at which you can sell. You understand? You are selling.
Sir, sorry, sir, for the interruption. I think one should put it at the back of his mind that as a seller, you are going there with the motive of making profit. You cannot sell at a lower price.
But
it's not impossible, oh.
Hello, sir. I think
it's not impossible.
The way
sometimes
I'm looking
your
at
trade
it
can trigger at a lower price. Yes.
The way I'm looking at it from is you know, in trades, actually we do it with this thing. So it actually happens that you can actually buy at a higher amount. Then when you are selling, you sell at a lower price, maybe based on the market price that is available as at that time you are selling. I don't know if you get what I'm saying. So suppose I bought a particular asset, maybe stock at let's say 15 naira. So when you are selling, so you can actually sell at loss, probably based on just like we are saying, expectation, market expectation and everything. So maybe price comes low, just like MTN. MTN, maybe I bought MTN price at stock at 15 naira. Then probably as a result of maybe there's something that happened in the market share. So maybe the following month, or maybe we will now see that, okay, this can actually further decline. Let me quickly sell.
Okay, let me come in. See, let me tell you
Sir,
something. You are looking at
you people are missing what Mr.
what
Alfred is saying. Sir, if I may, sir. Hello, sir.
Go on. Go on.
You people, I believe most of you are missing what Mr. Alfred is saying. What he's simply saying is that bid price. You are selling at that bid price. Now, if you are selling at that bid price of 49.75, you will have the assumption, you are working on the assumption that, okay, you are selling because there's a likelihood for those, some of you that mentioned that you're into trading. It's assumed that the price of that asset now will depreciate further. So you are willing to sell at this price so you don't make a loss. Now, along the line, maybe based on economic circumstance, that the price is no longer falling, now begins to rise. You now say, oh, I can now buy at this price because I assume that the price is going forward now, it's going to go up. That's where you now buy at the 50 naira. I don't know whether that's what you're saying, sir. That's the way I understand it.
Okay.
Hello, sir.
Let me go back to
Hello?
wait. Sorry. You asked your question. So I will go back. Let's leave this this part that you guys are pushing me to explain some things that I think we need to explain for later. This part on my Excel that I'm marking out now is red. I'm marking somewhere red, so it will just go out. Don't pay attention to it. Let's go back to the question. Look at my Excel. You buy A at 49. Now on this my workings, the bid, what a buyer is willing to pay is what I'm looking at this thing from now, right? So I'm going to strike this side out now. The bid price, what a buyer. So now in my example, I say you buy. So you buy for this price, 49.75. Is it making sense? So in this case now, you are the buyer. That's why I say you buy A, you are A, you buy. So what a buyer is willing to pay. So you are willing to pay 49, right? And that's what the question is. Suppose XYZ is bid, which is the bid here. That's why I told you to take a position. Indeed, if you come down to this Excel, this part where my cursor is now, can you see my cursor? I say constant. Now the first one you are buying, you are taking the position of the buyer in the bid. Madam, sorry, Madam Effie, right? You were the one that asked me that question. Are you getting the picture of what I'm explaining?
I'm getting you now. I'm getting you.
Right. So you are buying in the first case at a lower price. That is the bid. Now you are now in the offer side where you want to sell. You understand? I'm going to do the same thing I did. So I'm going to strike this part out. Because that's the way the question is putting it. Say you are now at the offer side, what a seller wants to receive. So you are now willing to receive at what? 50 naira, which is what you are selling. So you sell at 50, you bought at 49. Multiply that by the number of stocks you are buying, you are getting this price. What I did there was I took out the what is it called?
The commission.
Commission. So you are now arriving at this price. Does it make sense now?
Yes, it's straightforward.
Yes.
It makes sense now, sir.
Yes.
Good.
Yes.
Now, let me go to your question that you are explaining. Let me go to your question. Now, because you are buying or selling does not mean you are guaranteed a profit. We have cases where you can be selling or you can be, when they say you are longing or shorting the market, you long a position. When you long a position, it means you are in a buy position and you can only gain in a long position when the market is going high. If you are in a long position, that means you are buying. That's why I say you guys want me to start explaining things that you should know that we have not gotten to. If you are in a long position and you are buying, it means that when the market is coming down, you are losing. It doesn't mean because you have longed, you must gain at every time. So this market can go in your favor or against you at any point in time. The only thing you need right now is to make sure that you do a proper research. you do a proper technical and fundamental research as a trader. When I mean fundamental research, you are looking at the economic-wide factors that can affect the value of that asset. So if you are buying an asset and you are expecting that you long an asset, when you are in the market, they don't say you buy, they say you long the asset. When you long an asset, you would have done your research to see that that asset will go high in the future. But if the asset does not go high and it starts falling, your long position will give you a loss. The same thing happens when you short a market. You expect that the market will go down and you will make profit. But if the market starts going up, you will lose. Calm down. We will learn. Me and you will learn. You will understand things. You get. So just calm down. Let's take it one after the other. So I believe this one now is clear.
Exactly, sir. It's very clear.
Yes, it's clear, Mr. Alfred. But I just need to ship in one thing. I don't know if you can go ahead.
Okay, go ahead. You can go ahead.
Yeah, I got this very position very right. This ask and bid thing, I got it very right. But where I want to talk to us is the issue of now, I want to buy an asset, which was actually mentioned there to be for something naira. Then I needed to pay my broker for helping me to buy that asset. I just felt my own layman perspective that, okay, he's charging me 15 naira as an additional cost for helping me to buy. If I'm to add it to, I feel that I should add it to the cost, the actual cost of the price, which is 15 naira plus that 49.75. That give me the actual amount that it requires for me to get an asset. Then when I now took a position again, that I want to sell the same assets to B, right? Now I'm to sell through a brokerage, a broker as well. And the broker is also asking me that for me to help you sell again, I'm going to still charge you 15. So if I add 15 to the 15 naira that is going to help me to actually sell it, by the time I net it off each other, it's going to arrive at 25 naira. Is that position making sense? Or because I just feel that
going to arrive at
the same amount.
That's what I'm saying. It's the same thing. It's just different perspective. It's the same thing.
Hello, sir.
Do you get? Yes, I'm with you.
Yeah, I said something the other time. I'm not saying that as a marketer, everybody as a business person want to make a profit. Like you said, it's like the devil is full of uncertainty. It has uncertainty inherent. For example, you buy something, if you want to sell it, your mind is to gain. But because of market volatility, unforeseen events, and other factors that can make the value of that thing, the stock you have to fall. So it's either you gain or you lost. But initially, you are not going to the business because you want to make loss, but because of the uncertainty and other factors which you mentioned that can make the price. That's why you said something that has to be strategic. You have to be someone that will be study that market trend so that you can quickly sell your market at the right time. If you are the person you are so greedy, you think it will continue to go up, it can fall. Then you go on with what you have.
You are very correct, madam. I'm clapping for you. You are very correct. So you have to be you have to do your due diligence very well. That's what she's just saying. So there is no guarantee. Don't allow greed to take over your mind by the other side.
Is it greedy? You can also take risks too now. If you are a risk taker.
Yes, it depends on your risk. It depends on your risk appetite,
and your
right?
liquidity.
It depends on your risk appetite and your liquidity. And again, no go basic trade. Don't go and take credit and use it to trade. If not, they will not only lock you up, you still have money to you will lose your money. So all those kind of things.
Hi guys.
So guys, sorry KB, sorry to cut you. I think I've had fun and you've had fun, and I know we are going to have more fun. But I would like to call it a day here. So, like I said, my notes will be shared with you guys within the week. There's so much we'll do. There's so much to deliberate on. I like the way we learned. I did not teach you like I'm teaching newbies. We discussed. That's how I like it. So in my class, we'll learn together. We'll discuss things. We'll discuss questions. We'll discuss scenarios. So that when you go to the exam, if ICANN is wrong, when you finish solving their wrong question, you will put their correct them in the paper there. You will know what you are doing. What I'm saying is you will know what this is about. You will not just be able to solve questions, just go there and solve. You will know it. That's my target. You will know it. So we'll have more fun together. Thank you very much, and I'll see you.
Please, Mr. Alfred, drop the notes for us, please. The notes.
Let's clap
Thank
for
you, sir. Thank you,
Not
sir.
Abiru, please, over to
Can we have the
Thank
notes?
you.
Can we have
Not
the
this
notes,
evening,
sir?
please.
Yeah.
Not this evening.
You will have it.
I know later. Some of us do print it out.
Standing ovation, standing ovation.
You will have it.
Standing
So let's
ovation for Mr. Alfred and Mr.
say,
Kabiru.
Thank you, sir. Thank you, sir.
yeah,
Thank you, sir.
this is a
Thank you, sir. Thank
very
you.
nice class. I wish that the class do not end, but only that. Hello, can I have the class?
Yes,
sir.
now we are here with you.
Sure, sir. Sure.
Okay. So, Mr. Alfred, thank you for this class. It was a good makeup class for the other time. The Nigeria happened to our network on Sunday, last Sunday, and then we are making it up in a good time. Everybody is happy. People are they are satisfied. We learned. I also learned. Right, I was following the class from the beginning to the end, which is so unusual, and that's the spirit of facilitation. We are not here to teach or to give instruction. We are here to coordinate a discussion. So it's a discussion, it's a collaboration. It is a facilitation. That's why we are better called facilitators and not just to say we are lecturing, right? Because every one of us, we have not had this opportunity to pass this exam. Some of us has a better experience in all these things that we are saying at our workplaces, or some who have had one investment or the other, and that is why it is better to call it a discussion so that we can all learn. Sometimes the tutor might just have a book or a textbook understanding of some scenarios or some discourse, but the students would have a better understanding. And then why? Because their own intervention has gone beyond the books or beyond the textbook. So they have actually seen it, they have witnessed it, and you guys might know better. If you continue this class from today till tomorrow, the expectation is that some persons might still not get some of the rudiments or some of the inputs of the class, right? So, and our own expectation is that, okay, after the class, and that is why we are recording, so the classes will be on our YouTube pages, so you can go over it again. You will have the material. You can also go over, attempt questions on it, and then be able to have a better understanding on it. If anything is not clear, you can reach out to the tutors and get more clarity on it. And I am of the opinion that no matter how a tutor tries to explain any concept or any subject in class or any topic, to me, the highest that one can get at that spot will not be more than 60%. Students will only rise and get to maybe 80% when you go over it again. And you will attain maybe 90% or 95% of that particular discussion when you have known it to the extent that you can teach others. So, and that is the theory at which we are also working towards. Because if we say, okay, let's attend to every question, let's make sure every single person is carried along, the time will just be spoiled, and then at the end of the day, we may not achieve that. So, thank you so much, guys, for this decorum. I appreciate it. It shows that, okay, ICANN is actually building not just anyhow tutors, a good generation, mind-blowing generation of professionals in the few years to come. So our class will continue. Alfred, are we holding the class for tomorrow? or you will meet next time?
No. Tomorrow they will meet with some other lecturers. So
Oh, okay. So tomorrow you meet. I think with the tutor you're supposed to have met today, right? Okay. Okay, no problem. So your class continues tomorrow with another person. So until then, let's call it a night. So we draw the curtain. Thank you so much.
Thank you, sir.
Thank you,
Thank you, everyone.
Thank you, sir.
Good night.
Good night.
Nice.
Good night.